Multifamily has been one of the most popular product types within commercial real estate for a while now, but today we're starting to see some significant headwinds with delinquency rates increasing, supply coming online in record numbers right now, and vacancies starting to tick up in many markets across the country. And because of these changes, investors are starting to see rents flatten out or even decrease in some markets, which is causing issues for investors who have loans coming due at interest rates that might be 2 to 3 times higher than what they were when these loans were originated. So in this video, we'll talk through the challenges ahead for the multifamily industry, what might contribute most to these challenges, and the things that are saving multifamily investors right now that can hold on for the long term. So right now, we're seeing a major shift in multifamily performance from double-digit rent growth in many markets across the country in 2021 to national rent growth flattening out since the fourth quarter of 2022, at the same time that operating expenses related to labor, material costs, property taxes, and insurance have all seen historically high increases over the last 2 years. But the biggest headline for multifamily right now that's leading to a lot of the issues we're seeing today is related to incoming supply of new apartment buildings, with roughly 670,000 units expected to be delivered in 2024, according to RealPage, which represents a 50% increase over 2023 deliveries, which already represented a 36-year high in supply. And according to Yardi Matrix, over 766,000 multifamily units were currently under construction as of the first quarter of 2024, which represented a 36.6% year-over-year increase and more than double the number of multifamily units that were under construction at the start of 2020. And while this is a national issue, some markets are seeing even more supply pressure than others, with 11,800 units delivered in Nashville, Tennessee in 2023, representing 6.9% of the existing multifamily inventory in the market, 16,000 units delivered in Orlando, Florida in 2023, representing 6.7% of the existing multifamily inventory in the market, and 20,000 units delivered in Austin, Texas, representing 7.7% of the existing multifamily stock. And this huge inflow of new supply gave renters significantly more options and resulted in material rent decreases within these markets, with Nashville seeing rents drop by 2.3% year over year in the fourth quarter of 2023, Orlando seeing rents drop by 4% during this period, and Austin seeing rents drop by 5.8% year over year in the metro. These supply increases have also caused vacancy levels to increase across the entire country, up from just 2.5% back in the first quarter of 2022 to 5.8% in the fourth quarter of 2023, according to Newmark data, which represented the highest national vacancy rate we've seen since the early 2010s. And at the same time that rents have been falling, the capital markets have also been responding to the rapid rise in interest rates we've seen over the last few years, with cap rates on multifamily deals continuing to climb, in some cases rising by anywhere from between 150 and 200 basis points from the cap rates we were seeing back in 2022. This has led to decreases in multifamily values in many markets across the country of anywhere from between about 15 to 30% or more, which has led to a rapid drop-off in transaction volume in this sector, but also issues with refinancing when existing loans are coming due. In the first half of 2022, a typical Class A multifamily property located in suburban Houston would have traded for roughly a 3.75% cap rate, and assuming the property generated $1 million of annual NOI, this deal would have traded for right around $26.7 million at that time. But with the increase in cap rates that we're seeing today, even if we were to assume a very healthy 20% NOI growth since acquisition, which is pretty unlikely given that rents effectively stayed flat in 2023 in the Houston metro, that same suburban multifamily property in Houston would now trade at roughly a 5.75% cap rate today, resulting in a drop in property value of almost 22%. And if this property were financed with a 65% LTV loan at acquisition, that $17.3 million of loan proceeds would now need to be replaced when that loan matures. And at the new property valuation today, a 65% LTV loan would result in a cash shortfall at refinance of over $3.7 million, representing over 40% of the investor's original equity contribution. Even for borrowers that don't have loan maturities coming up immediately, many multifamily properties acquired in 2021 and early 2022 were financed with floating rate debt priced at 1 month SOFR plus a spread of anywhere from between about 200 and 400 basis points in most cases, and with SOFR coming in today at right around 5.3%, interest rates that may have started in the 3% to 4% range back in 2021 or 2022 might now be up between 7 and 9% in some cases, which is causing material levels of distress for some multifamily owners. Now, with all of that said, even though there are a lot of things to be concerned about in the multifamily sector, this product type also has some really big tailwinds that are keeping demand strong, primarily being fueled by the massive increase in home prices that have continued to rise even as interest rates have increased. After a quick and very slight decrease in single-family home values at the end of 2022 and the beginning of 2023, home prices have shot up again over the last year, now sitting at an all-time high nationally of over $347,000 as of February of 2024. And with 30-year mortgage rates coming in at over 7% today, even for qualified borrowers, if we were to assume an additional 1.5% of the home value to cover property taxes and insurance, a 20% down payment for this average home would result in a monthly payment of over $2,318, which is 7% higher than the average national rent according to CBRE. And while a 7% difference might not seem like much at the national level, these costs are substantially different in major metros across the country, with the cost to own in New York City coming in at $4,894 per month versus just $3,450 to rent, the cost to own in Los Angeles coming in at $6,366 per month compared to just $2,750 to rent, and the cost to own in San Francisco coming in at $8,257 per month versus just $3,234 to rent on a monthly basis. Renting is even significantly cheaper right now in larger secondary markets across the US, especially those that have seen the most job growth in recent years, with the cost to own in Austin, Texas coming in at $3,565 per month versus just $2,100 to rent, the cost to own in Boise, Idaho coming in at $3,161 per month versus just $1,736 to rent, and the cost to own in Raleigh, North Carolina coming in at $2,902 per month versus just $1,850 to rent in the market. And on top of the record high cost of buying a home today, even though the supply pipeline for multifamily properties is significant throughout the rest of this year, this is expected to decrease relatively quickly starting as early as 2025, with new deliveries expected to bottom in 2026 according to Yardi Matrix due to construction costs, labor costs, and financing costs that have made it prohibitively expensive to build new product. And because of this expected drop-off in supply, many multifamily markets that are expected to see an oversupply of deliveries this year are actually expected to see a shortage of multifamily units going forward, with metros including Las Vegas, Los Angeles, Chicago, and Orlando all projected to have an undersupply of multifamily units by 2025, according to Fannie Mae research. And according to RealPage, supply being delivered nationally in 2025 is projected to drop by 15 to 20% in most major US markets, and in just the second quarter of 2023 alone, there was a 41% quarter-over-quarter drop in market rate apartment starts, representing a huge downshift in new construction activity that would have otherwise been delivered over the next few years. Ultimately, while the short-term picture for multifamily investors isn't looking great right now, if we zoom out to 2025 and 2026, especially in certain pockets of the country where demand is expected to continue to grow, multifamily is very likely to recover relatively quickly and continue to perform well over the long term. And if you want to learn more about multifamily investment analysis, how to create a multifamily acquisition or development model from scratch in Excel, or how to build the skills you'll need to land a job at a top multifamily investment firm, as always, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on the multifamily product type specifically, make sure to hit the like button and let me know in the comments what other product types you'd like to see covered in a similar format to this in a future video on the channel. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.